All right. Good morning, everybody. Small caps gave it all back, it looks like, or it wants to. We have some job numbers today. It's not the biggest, but they are important. They go right to the Fed's dual mandate. They were focused on inflation, and they've announced, that they slayed that dragon, and now everything is focused on jobs. Anything having to do with jobs, you want to pay close, particular attention to. It's really important. And we're going to get unemployment numbers this morning, so it's kind of a big deal. Taking a look at what's going on around the world, small caps are basically flat. They're not participating in anything this morning. The beatdown that we saw in semiconductors over the last few days looks to be ending, which ties in with the whole Bitcoin move. We don't have anything from Spot Gamma's founders note yet on the AM edition, but I did put the evening edition out already. Now that we're through with the VIX expiration, I'm interested to see what they have to say. They did highlight a little bit of NVIDIA and some chip sector material. It's worth a read if you haven't checked it out yet. And they're still talking about the election, which is going to be the next biggest thing. But as we were discussing yesterday afternoon, we've got a lot coming up in that first week of November, the last week of October. So we got QRA right before Halloween. Then we've got FOMC. It got the election. That first week in November is going to be a doozy, and it's going to start in October with the QRA right at the end of it. So that would be like the 28th, because it's two parts. QRA on Monday is the early announcement, and then the final announcement is on the 30th. NASDAQ up more than everything else, so a little bit of diversion between the S&P and the NASDAQ. Generally, these are in sync. So we're going to look for the S&P to get caught up with the NASDAQ, or we're going to look for the NASDAQ to get caught down to the S&P. We still have the problem of a potential liquidity gap. So we got to keep that in focus as well. There's a trigger on initial jobless claims, and this kind of do not cross level. It's at like 263, something right around in there, 267, and we're at 260. So we're getting really close to a level that we do not want to cross. And if we cross it, we're likely to see some serious volatility in the market. So 8:30 today, it's a real big deal. And then 9:15. We talk about watch the clock all the time. And generally we talk about the half hour and a new hour, but this just goes to show that there are quarter hour events which are worth paying attention to as well. Plus, when treasuries open and bonds open, you got some of those that don't land at 8 a.m. and it don't land at 8:30. It's like an 8:15 open or an 8:20 open. So it always comes down to watch the clock. We're also getting data out of Canada, Europe. Later today, we're going to have the European press conference. We've got Fed speakers out chipping their teeth. auctions today at 11:30. And then in the overnight, we've got data coming out of Japan. So it's just nonstop today. It's going to be coming at us. And we formed that failed flag that I had talked about yesterday, which has now run us back up, and we've got a large cup shape. So yesterday, when we were looking like this, that's the failed flag. It hadn't failed yet, but the idea was if it failed, meaning we didn't continue lower, then we would circle back around to the other side, and that would give us a large cup. And then we would be trying to figure out if we're going to get a handle on that cup. Well, there you go. We've circled around back to the top. Now the question is, are we going to get a handle? We got to stay above 5,900. It's a round number. It's a large options number. But it's also the 786. So it's the key. We got to stay above that. We're going to get data at 8:30, which very likely gives us a liquidity gap candle, one of those really big candles. And that could put us down through that level. But that would be different than us working our way down through that level, right? So if the econ puts us below that, then, you know, and it's a liquidity gap, we'll expect to run back up and close it anyways, 59.11 cog line. But if we get the job numbers and we don't really see a response out of the market, which is completely possible, and then we work our way down below that level, that's going to be a big deal. Otherwise, we are primed for one of those runaway, rip your face off rally days. We don't have a high correlation yet, but it's what you're going to want to watch for, and we'll walk through those parts and pieces. The VIX is now down below that 20 level. We're still not, you know, in a low VIX, low vol environment. Anything above 15 and below 20 puts us in just a pullback environment. It's still considered high volatility. So we're going to need to keep our eye on the VIX. So I've showed this before. This won't be something new to most of you, but we have the potential for a liquidity gap. And this is not a price gap. Like if we close at 100 and we open at 105, that would be a price gap. This is a liquidity gap. At 8:30, we're going to get job numbers, and we very likely could get a very large candle such as that. We want to focus on where that candle opened, because that's what we got to get back to. So if you notice in this picture, there's almost no wick up there. And cut the candle in half, use your quadrant lines, and plot the midpoint. We want to see the candle close way beyond that halfway point. If we broke it into 4 parts, we want it in the lower 25%, or if it's going the other way, we want it in the upper 25%, right? We want it to close in that zone. Once we get that print, we'll look for the gap to get closed. This one closed around 11 o'clock. Generally between 10:30 and 11 is what you'll notice if you keep track of these kind of candles. Now they can happen anywhere. You can get them intraday. You can get them, you know, in the Globex overnight. So it doesn't have to just be this 8:30 print, but it's almost like Back to the Future and knowing when lightning is going to strike, right? Exactly when and where it's going to strike. That's what we get with these 8:30 economic events, is a chance to anticipate one of these very large candles because we know when it could happen. Now I get it. Some people actually want to trade that big candle. They want to trade the move as it's unfolding. Some way to identify if whatever economic event is going to make us bullish or bearish and then get in for the run. If that's what you want to do, I'm glad you're not using my money. Go ahead, do you. I'd rather focus on, once we have that candle, what can we do with it? I like to play the gap close, and we can also measure that candle and lay out quadrant levels from it. The midpoint offers an opportunity. Then once we get the gap closed, we can project that entire candle's midpoint 50% and 100% above and below. So no matter which direction we go, we've got levels to play from that one candle. You can see with this one, there wasn't much of a wick at the open, and it closed in the upper 25%. It got the gap closed around 10:30, so we made it back and overshot. Overshooting the gap is really common too. Here's a CPI example. Now, if you notice, it pulled back almost more than that 25% that we've been talking about. But in the next candle, it held within that zone, basically from where it closed to where it was the highest point. It stayed in that range, and then it continued on for a couple more candles, built a solid base, then began working on the gap close, got there after 10:30, but before 11. So I like playing the gap close. If you don't want to play it, or you don't trade futures, you don't have access to the markets before the open, then at the very least, maybe I can save you from going the wrong direction. Here's an example of what we don't want to see. Right? I always find that adding examples of what we don't want helps people better understand what it is that we do want. This has some wick along the bottom. Once the econ hit, we actually went down a little bit before we went up. It left a really long wick across the top. If we were to break this down into quadrants, it closed underneath the 75% mark, and it was really close to the halfway point. I keep this picture around, one, to show what we don't want, but two, to show that when we measure that candle and we lay out the midpoint, price responds to those levels. I didn't put the 123 and the 111 along the bottom, but I could have, and that would have shown the liquidity gap or liquidity zone down there, and what we got tangled up in and where the reversal was. Later in the day, when we finally did get the breakout, it ran right up to the OCC, opposite candle color, and it's what we got, opposite candle color. We flipped around, went back the other direction. Liquidity zone, all measured out from that one bar. So even if we get a bad candle and it's not the gap close candle that we want, if we get a very large bar and we can't use it for a gap close, we can still measure those zones and levels and plot them out and use those. This would have projected 50%, and it's what we hit across the top here too, is 50% of that move. It's another example of what we don't want. Price left big wicks on each side, closed closer to where it opened than what we would want. So we wouldn't trade this as a gap close, but we would want to mark those levels, measure the entire candle, plot it to the downside 50% and 100%, mark the midpoint. It'll be tradable opportunities when price comes back into that zone. Same with this one, 50% marked out the high. And if we had marked the midpoint, it's where we tagged here, got a nice run off of that. So with the opportunity that we have today with so many different economic events on the table, we could see these candles in the middle of the day, just like this example where we got a liquidity gap at 10 o'clock. Then we got another one at 12:30. That one got closed really fast. We got another one at 3 o'clock, which dropped us down to close the one that we had started at 10. And then we ran back up and closed that one before the end of the day. So these liquidity gaps can happen all over the place, and they can give us opportunities to trade. Even the midpoint on this one, it doesn't look like we quite got down there and hit it, but I'd say it was pretty close. You know, even the mid on that 10 a.m. liquidity gap provided the stopping point for the drop that we got at 12:30. So we want to use what the market gives us. And on a day like this, it's giving us an opportunity to play this liquidity gap. Having said that, once we're done with the job numbers this morning, we do have other events, but we've already seen a significant amount of pressure this morning, driving us up through this range and into an ADR half. A lot of history shows that if we get to the ADR half really early in the day, we can go to the other side by the end of the day. I can't tell you how many morning briefings where I've said those words, and by the end of the day, I'm cutting out that little part of the recording and sharing it as a highlight of, if we get to one side early enough in the day, we can go to the other side by the end of the day. I'm not saying we're going to do that. I am saying that's on the table. No matter how bullish, no matter how bearish, in the first 30 minutes of trading between 9:30 and 10, the markets can change their direction. 50% chance that we go the other direction between 9:30 and 10. That's a statistic that's been around for a long time, and 50% is literally a coin toss. No matter how bullish. And this morning, I mean, we're pretty bullish. But we've already reached the ADR half. If you haven't really done a lot of work with the ADR, the idea is every market out there has a typical movement, an average range that it makes on a day-to-day basis. From its highest point to its lowest point, how far a market moves each day. So once the market opens, how far we could go up or down. And then the next day, how far we could go up or down. That distance is an average daily range. And sure, sometimes we get big moves that are much larger than the typical move. The average daily range right now is about 1%. It's 0.96. So if you think about it, from the open, if we go up 0.5% and down 0.5%, then the distance between that high and low is 1%. But what if we just open and go one direction, 1% up or 1% down? Then that would be a full ADR going in a single direction. So we've got the ADR half. From where we open in Globex, we could go up half, down half. But we could also just open in Globex and go down 1% or up 1%. So we're already at the half. We're already doing what we have typically done over the last month, because this is a 1-month ADR. That's the average move for the ES in the last month. We're done. If it continues to be bullish, then we could drive to the full ADR and then overshoot that, since we're close enough to something like a call wall. We could overshoot that and get up into 59.50. It's not that far away. On the other side of that, if we try to break out, we get into this liquidity zone that's up here and we fail to get through it, we get that rejection, we could begin to move to the downside, and we could be at the lower ADR by the end of the day. If things get nasty, because we could do that without even any nastiness to the market, but if things get nasty, we could hit the volatility trigger and 0 gamma by the end of the day, 58.11. That's only 100 points. That's nothing. S&P can move 100 points, no problem. It's just about a 2% move from top to bottom, from where we're at right now, down to that level. It's been a while since the S&P made a 2% move on the day, but we can absolutely do that. Just don't discount it. At the moment, however, we are just in this range and we're waiting on data. That's simple enough. GTFO, we got to get out of this box, right? We got to get out of that zone. Until we do, we're just like a pinball bouncing back and forth from one side to the other. Today's floor pivot is within yesterday's floor pivot channel. That's more neutral than anything else. Price opened above it, but already ran down and hit it. We've interacted with it. The lower channel acted as a supportive function. And we got our inside day breakout with a nice expansion. Notice how it responded to the liquidity zone when we got that breakout. If we was to have measured all of yesterday's range, which is not generally how I do it, but we'll just do it the easy way. You can see how we got tangled up in that liquidity after the breakout. Generally, if I'm projecting to the upside, I'll use the highest body part and the lowest wick. If I'm going to the downside, I'll use the highest wick and the lowest body part. When we line it up that way, it's a perfect tag on the 111. We hit 111, which is the liquidity zone, digested it easily, and then continued the move all the way up and into the intraday high back here from the 15th. Now, we could just measure out our own Globex range and deal with that. There's nothing wrong with it. We can catch our 50%. There's our halfback 58.92 cog line. It's also the intraday high of yesterday. You notice how that lines up. Things are just awesome that way, right? If you're doing your drawings right, they'll line up with other levels, other pivots. It's confluence. So if we do fade to the downside, 58.92 is a cog line. It's the previous day's high. It's very likely to offer some sort of supportive structure. Whether or not it can hold, who knows, especially if that move happens as a part of the economic data that we're going to get at 8:30. Volume profile shows us run right back up where we were. So we got the point of control underneath this 58.84. This is a pretty nasty looking profile. It's not offering a lot of insight. No clarity of a clean D shape. It looks a lot like this one with a bunch of spikes in different locations. Those spikes are high volume nodes. They're areas to focus on as magnets and then areas where we get stuck. So once we left this zone behind and we were headed to the upside, that was the target. We start to break down here, getting back to the point of control will be a target, and then getting down into this lower level, 58.65 is a target. If we break that low of 58.50, then we've got 58.32 cog line and then 57.92 cog line. We do have the 3-week moving average and the 10-day moving average underneath this. Those line up pretty close with yesterday's low. So more supportive structure. We can see the trading this morning sitting in the 80s. That's pretty good. It shows they're not sitting out, and we don't see any hedging. So as much as I'm concerned about the job numbers, they must not be, because we're not seeing hedging activity in front of it. $10-day, 30-minute volume profile with TPO This thing's an absolute mess. We've got high volume nodes all over the place. Over the next week, we're going to lose what's down here. So as long as we remain above 5850 or maybe 5800, then all of what's down here is going to disappear and we'll tighten this zone up considerably. The thing is, if we think about the next zone higher, it's going to be 5950 and then 6000. All right, so one leg at a time, thinking of it much like lanes on the interstate. We were down in this lane, then we shifted and we're in this lane. And if we shift again, we'll be in the next lane. Level by level. Right now, we do have a disagreement between the TPO and the volume profile. The point of control for the profile, 5832, while the other one is 5750. It's very likely that this will get adjusted through the day today, and TPO will match the volume profile by the end of the day, maybe by the end of the week. I don't think it's going to take that long, but we'll see. Five-day, 5-minute volume profile with TPO on the far right. The TPO is only looking at today. Each volume profile is only looking at today. So this isn't an aggregate like the other profiles. We can see the point of control that we had marked out from Tuesday was hit in Wednesday's trading. We ran up and hit that level, ran right through it, really, like it wasn't even there. But we're done with that VPOC now. We don't have another one because what we would have built for Wednesday, we ran through last night. If we fall away from here and the point of control stays across this high, then we'll have one for tomorrow, perhaps. We have a disagreement this morning between this TPO's point of control and the volume profile's point of control. It's very likely that this is going to shift up soon. It just hasn't done it yet. The one in blue, TPO, is time, price, opportunity, TPO. If you look for it on Thinkorswim, that's what it's called, TPO profile. The one in green is a volume profile. They look very similar because they are very similar. The one in green is volume. The one in blue is trades. So we call it volume by price and volume by time. Generally, they're going to stay in sync, but there's times where you can find like a ceiling or an iceberg. These time frames aren't really good for that sort of insight, but still relevant. And when there's disagreement, it should get your attention. So right now we've got a lack of trading versus a lack of volume. We hit something really big up here. Large positions. It took less trading to get that much volume than it did down here. So we had a lot more trading down here, but in much smaller position sizes. Looking at where we're at on the week, Monday is still the boss. Everything that we've done this week has been based on what we did Monday. From that, you can get your midpoint, liquidity zone, OCC level on each side. And Monday's low lines up with Friday's close. 58.50 option level. It's kind of a big deal. To the upside, if we continue this move up, we've got 59.50. It's another options level to be focused on and right in front of a call wall. Looking at how far away we are from the moving averages, we're 1% away from the 10-day moving average. If we continue to make that drive to the upside, we could expand into like 1.5, but we don't want to really see it get above 2.0. We don't want to get too far away from that 10-day moving average. If we get too far away, we're at risk of a snapback. We'd run back the other direction. So we're not overbought yet, but if we do make, say, a 2% move today, then we would get into that overbought territory on the 10-day, and we'd have to be worried about that. Not right now. Looking at how far we are from the 10-week, we're at 3.3%. If I put my mouse there, you can see we've been higher than this before. That's not really too much of an issue, but we don't tend to stay that far away. So once we start getting into 3.5%, 4% above the 10-week, then we get at risk of correction. Now, don't let that word freak you out. We can get a correction in time or a correction in price. A correction in price would be we turn around and we go back towards the 10-week. That's pretty obvious. The other one, correction in time, would be that we just stall out here and then we hang out for, a few days and let the 10-week get caught up with us because it's coming towards us whether we like it or not. So a correction doesn't have to necessarily mean a negative market. We're not to that point yet, but if we get above 4, that's going to be the concern. So we'll start getting into that area where we need a correction. It's not a good idea to focus on that word overbought and oversold. I think it really gives a negative image or a negative idea, especially to newer traders. It's better to focus on correction territories and the idea of how price could correct or why it would correct, rather than thinking that something's overbought, like it's been bought too much, and that just gives you the wrong idea. Financial still leading the way. Tech got the healthy pullback that it needed. It was basically a Busby. The idea with a Busby is that price generally will fight a range. So it hits a resistance, and then when we finally get a breakout of that resistance, a lot of times price will pull back and validate the old resistance as a new support. Over the years, I got tired of saying that. That's a lot of things to say when I could just say it's a Busby. It's a very simple concept. When we break resistance, we often validate that old resistance as new support. We just pull back and bump it, check it. So that's a Busby. The thing is, a Busby only owes us back to the top. It doesn't owe us anything more than that. If you look at trends, though, over the years, some of the biggest trends that's ever come out in history started with price in a range, fighting resistance, and when it broke that resistance, it pulled back and bump checked it as new support before it began some of the biggest trends in history. So Busbys can signal the start of a new trend on any time frame. So while it only owes us back to the top, it has the potential to be, the start of a whole new run. It's a healthy thing to see that pullback, by the way. So if we look at, the semiconductors and now all of that, they've been really extended. They needed a pullback. Tech represents that pullback really well, and we got it. Now we need to complete the Busby and continue to move. If we look at all of these, and I know it's a very noisy chart, there's a lot of stuff on here, but just look at the labels. There's 9 labels on this screen, and their color code makes it easy to see the ones that are up and the ones that are down. Since we're looking at daily charts, when it says 5-bar change, It's a 5-day change. What's the market done over the last 5 days? The top three are risk on, the bottom three are risk off. The three in the middle are what we call the midline sectors. And this isn't everything. If you notice, there's communications isn't on here, semiconductors aren't on here. Every sector and index, you could do something like this. Commodities and just all kinds of different ways to build these out. If we're looking for an everything rally rather than a growth versus value rally, then this is the kind of chart we want to see, where almost everything on here is in the green. We do got to be a little concerned with things like energy, because they'll often do it their own thing. And right now, tech or semiconductors are the ones that had the issue. ASML and all that brought it to the downside, but utilities up more than 4.5% in 5 days. Big move. I got out of my short and it went a little bit lower after I got out. I think I got out on that day there. Maybe one of those 2 days I got out, and it kept going lower. And I thought, well, shoot, I should have stayed in. I got out too soon. Well, nope. I feel pretty good about that exit. Same thing with XLP on staples. You know, all three of these were doing great to the downside, and now we're getting that rotation back up. The thing is, it looked like we were getting a growth versus value rotation. Tech was going down, staples and utilities were going up. But this morning, the Mag 7 is up, semis are up, you know, growth is up. So if we also have value up and we got both growth and value, we start getting that everything rally. It feeds into the narrative that we could have, you know, a very bullish end of 2024. We still got the election issues, and that's like earnings. You know, there's no edge in trying to guess which direction we're going to go. It's generally a waste of time to see what's up or what's down in front of an economic event like the job numbers, CPI, PPI, non-farm payrolls, because no matter what's up or what's down at this point, until we get those numbers, none of this matters. It could all change by 9:30 just because we get some bad job numbers. So I wouldn't spend too much time this morning looking at the Mag 7 group, or, you know, identifying what sectors and industries are up versus what are down. Wait until after 8:30, then get a look at what's happening after that 8:30 economic event. Having said that, the China ADRs over a 5-day period, they're now down more than 6.5%. This morning, they're down 2.75%. So the China group still fading, and likely will continue to fade into the end of the month when we get that big meeting that's going on over in China government, and they work on new stimulus measures or whatever. They got to bolster confidence. Bitcoin was up more than 13.5%, more than 14%, really. And it's down now 1%. That feeds in with the narrative of, you know, the chip sector coming back around. So as long as Bitcoin doesn't just completely fall out of bed, the semiconductors should be able to hold up and maybe even rally on. Looking at the things that are up, what's that? Semiconductors, the Mag 7, uranium, technology, gold miners. Now you take something like the semiconductors, they were down more than 5% over the 5-day period. Now they're up 3.25% this morning. So a very large move in the other direction, all because of Taiwan Semiconductors kind of changing the narrative after the ASML debacle. But that just goes back to the warm, fuzzy feeling and the narrative on sentiment. It doesn't change anything other than the narrative. But look at how many stocks are up in the S&P 100 that are up at least 0.5%. We've got 14. Well, look at the groups that are in there. Out of those 14, almost half are semiconductors. Then we got some medicals and chemicals and internet stuff, and sure, we got a lot of Mag 7 in there, but we've only got 14 names, right? So S&P 100 names that are down at least 0.5%, only 4. So 4% is down, 14% is up, at least 0.5%. Now the Nasdaq's up way more than the S&P is up this morning. 32% of the Nasdaq is up more than 0.5%. That's pretty bullish. The problem is, look at all these semiconductor names, right? Out of those 32, what, more than half or at least half are semiconductors. So all leaning on Taiwan Semiconductors, and then NVIDIA with its big move causing a wave or a rising tide that lifted a lot of the others up. Even Intel, the dog that just keeps getting kicked, even that one's up this morning. So that's more of a sentiment play than anything else. But the thing is, when we get one of those rip your face off rally days, it's exactly what it is. It's just a ripper, and it just keeps going and going and going when everybody else thinks there's no way it can keep going from here. And then it just goes even more from there. What you'll want to watch for today, after we get our jobs numbers, is go into the index watch. I know I went there a little fast. You got 3 tabs. You got the market watch, then you got the visualize, and then you choose what you want to visualize. And we want the index watch. Go into that and choose whatever index you want. If you've made your own, then you can do like a Mag 7 index or something like that. But they have these ones called public. So you can go in and you can choose the S&P 100. You can choose the NASDAQ 100. They're detachable, so you can load up as many of these as you want. Once you get those lined up and we get into the open, what you're looking for is how many you have advancing versus how many you have declining. If you have the NASDAQ 100 and 95 or 97 names are all going up the same time, then you've got that correlation index. And I built a trade strategy called the Alpha Protocol. If you got 97 names all moving in the same direction, you just buy every single name in your basket of stocks that you trade. Make it the size that your portfolio can manage, obviously. But say it's 12 names and you buy calls in all 12, or if we were going down, then buy puts in all 12, and you run the protocol. Out of those 12 names or however many names are in your basket, there's usually one dog that isn't working, and it'll stand out. So then you just, you close that call and let the others run. It's been a while since I've run the protocol because we haven't had the setup, but we have the potential today to see that setup form. So keep your eye on the advancing versus the declining issues and see if we get the Alpha Protocol set up. If you don't have a protocol, then consider, what that would look like. Choose 8 to 10, whatever your account can hold, stocks that you would trade in a bullish market backdrop or a bearish, right? When everything out there is going up or everything is going down, the idea is, why can't you trade like an algo the way the algos trade? Trade a basket of stocks. You don't have to just pick one. They don't. So China down, Bitcoin down. Out of those two, I really don't think we're going to see a change in China today. but we could see a change in Bitcoin. So look to see if we catch some structure there and flip that one around. And that'll be a part of the quote everything rally, right? And technically we don't need everything. It's likely we won't get energy, or maybe we won't get utilities, you know, something like that. But we should get everything else if it's going to be one of those days. Make sure after we get the jobs data that we still have things like semiconductors, technology. Those are the biggest. If we do start losing things like utilities, energy, maybe precious metals, it's not going to be that big of a deal, right? And keep in mind, as much as I may sound like this is a bullish day and we're looking at a bullish backdrop, if we get to this red ADR line early enough in the day, we can go to the other ADR red line by the end of the day. One more thing I'll leave you guys with is we're at the ADR now on the ES. The thing is the SPX doesn't get its ADR until after we open, right? So what happens because of that is if it's one of those days where the ES goes to the yellow line and it breaks above that and it wants to keep going and you're thinking, gee, when is this going to end? We just keep going higher and higher. Look and see if the SPX has reached the red line yet, because it's getting its red line at the open. And SPY also, even though SPY was up in the overnight, or it moves in the overnight, the idea is that SPY's lines won't draw until the open either. So SPY is another one that won't be at the ADR yet. And so it has room to run before it gets there. Notice there's no ADR lines because we're not into the open yet. So if it is one of those days where we just keep going and going and going, and the ES has already reached those levels, then check and see if the SPX has reached those levels yet, and or has SPY reached those levels yet. So what I got for you guys, watch the clock, be careful, be safe. I see y'all.